Hello everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 19th, 2025. Hey, I hope you're doing well. I hope you're having a nice weekend, and I hope you had a good trading week last week. Thank you for coming to my Week in Review podcast. I think I've got some good things to show you and teach you today, and I hope you're going to find it of value. So the format for today is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, uh, when I entered, why I entered, what the setup was, what the confluences of signals were, how I position size, how I'm going to place my emergency stops, end of day stops, how I'm going to take partial profits, and then ultimately how I am going to exit the entire trade. So we'll look at all the current positions, the current open positions. We'll see how those are doing. We'll take a look at my closed positions and why I got out. After that, we are going to talk a little bit about trader psychology. It is always the most important skill in trading, the ability to create a trading plan using good trading fundamentals, essentially, just good trading processes that allow for small losses but also allow for large wins. And that's really it. I mean, there's no secret trading strategy. There's a lot of good trading strategies. You kind of have to fit your personality. But the key is you have to format them so that you have the chance for a big win. And if you're wrong, more than likely, it's going to be a small one. And that all comes down to, so you can have this great trading process, but if you don't follow it, it doesn't matter. And that's where trading psychology comes into play. So I'm going to talk a little bit about that. Hopefully that will be helpful. And then I did go down through my master watch list last night. I do that every Friday night. I go down and I look and I say, okay, what markets are getting to a particular level where there's a combination or confluences of levels where I may be interested in getting long or getting short as well, right? So that's one of the great advantages we have as retail traders, the ability to sit and wait for the market to get exactly where we want it to. So I have identified a handful both on the daily time frames and the weekly time frames that I'm going to be watching carefully next week. And if they get there and they have the price action that I want and that I'll explain when we go through, then I will consider taking the trade. So I hope that's going to be helpful for you, give you an idea of kind of how I like to look at the markets and go, okay, if it gets there, that's the spot. So if this is at all helpful to you today, if you find some value, I really would appreciate it if you could hit the thumbs up button. It really does help the channel, lets YouTube know that there's some valuable content here. All right, so let's get this U.S. legal disclaimer out of the way, and then we'll get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, thanks for holding on with me through that, and let's get started on the first open current position that I have. It is MasterCard, MA. So MasterCard, I entered the trade on the 20th of June here near the lows at 532.95. So why did I enter here? Well, this is what is called a deep dip buy signal. It's one of the strategies that I use. It's one of the strategies that I teach. But there's, you always have a better trade if you have a confluence of signals. Like one signal is fine, but really two is better, right? So there are two signals in this particular setup. And the first one is a deep dip by rejection of the 200-day moving average. This is the black line here. This is a key level, a key moving average that large financial institutions and savvy traders key their trades off of for a good risk to reward ratio. So during the day on this particular day, we went underneath the 200-day moving average, but yet we closed above it. The closing price is the most important price of the day. That's when the large financial institutions come in at the end of the day and they move the price to what I consider the most valid price to make my buying and selling decisions from. So during the day, it went under the 200-day moving average. There were not enough sellers down there to keep it down, and it reversed up. So that by itself, this intraday rejection of the 200-day moving average, is a legitimate entry just by itself. However, at the same time, on the same day, if we look down here at the RSI level, Relative Strength Index, during the day, we were under the 30 RSI, and then we closed above the 30 RSI. A intraday rejection or a close under, close over the 30 RSI, again, by itself is a legitimate deep dip buy signal, but both of them happen in the same day. We went under 30, closed over 30. We went under the 200, closed over the 200. That's my signal. And again, this is what I'm talking about when I talk about confluences of signals. So I did enter here at 532.95. So now, when I enter a trade, when I find the signals, when I find the confluence like I did here, the first thing that I need to do is decide, okay, how many shares of this am I going to buy? And I have a simple formula that uses two inputs, and then I'll explain that to you right now. It's important that you position size based upon the current market volatility. So if the market volatility is higher, you're going to buy fewer shares. If it's lower, you're going to buy more shares. So takes two things into account. One, how much is in your trading account? Let's just use hypothetical $100,000. If you have $100,000, I take 1% of that. So 1% of $100,000 is $1,000. If you have $1 million, 1% is $10,000. If you have $50,000, 1% is $500. So let's just go with the $100,000 trading account. 1% of that is $1,000. And then the second value that I look at is the average true range 2, or 2 times the average true range. Right now it is 1976. If the volatility is higher, this number is going to be larger. And if I divide a larger number into this $1,000, I'm going to get fewer shares. So just right there, if volatility is higher, you're going to buy fewer shares. If it's a lower number, it's going to buy more shares. You're going to buy more shares. So in this particular case, $100,000, 1% of that is $1,000 divided by the value of the 2 ATR on the day that you enter the trade, divided by 1976. This formula would tell me to buy 50.6 shares. I just round that up to 51 shares. All right, and it's as simple as that. So now I know how many shares I'm going to buy. So I'm buying 51 shares here. Now, the first thing I do after I enter, and I did enter here at 532.95, I take my entry price and then I draw my emergency stop exactly 1976 below my entry. So if I have 51 shares and it goes down 1976, how much have I lost? I've lost $1,000. I've lost 1% of my trading account. Now, the good news is this only happens about 5% of the time. The other 95% of the time, if I have a loss, it is going to be because of my end of bar stop. All right, so I enter here, rejection of the intraday rejection of the 30 RSI, intraday rejection of the 200-day moving average. I enter at 532.95. I position size like I just described to you. I place my emergency stop, 2 ATRs, the value of 2 ATRs below. And now my end of bar stop is what? It's simply a close below the 200-day moving average. That's it. So if the next day it closed just a little bit below, even a penny, I would have gotten out of the trade. So this shows you what a good risk to reward ratio looks like. You have your emergency stop down here for the worst case scenario. And if the worst case scenario is what? 1%, right? But again, only 5% of the time that happens. 95% of the time, on this particular setup, if it closes below the 200-day, I am just simply out. So I have my signals, I position size, I place my emergency stop 2 ATRs below. My end of bar stop is a close below the 200-day moving average. The next thing I do is I find the value of the 1.5 ATR. Right now it is 14.82. It changes every day. I take my entry price and I add the value of the 1.5 ATRs above my entry price. So I take my entry price plus 1482 and I draw a line here. That is my trailing stop level. And all that means is in the future, after I take the trade, if it gets up to at least that trailing stop level, 1.5 ATRs above my entry, then I go into what is called trailing stop mode. And trailing stop mode just means now that I'm in trailing stop mode, in the future, if I have a close below a previous bar's low, I'm going to take off half of the remaining shares that I have. And what does that do? Well, as something moves your way, if it gets to a certain level, I want to tighten up everything. I want to tighten up all my stocks or all my levels. And by taking off half of the position, it automatically does that. It moves everything up because you've taken half off. So you've heard about tightening your stops as it starts to move in your direction. That is why I do this. Now, everything I've talked about so far, as far as the emergency stop, the end of bar stop, the going into trailing stop mode, these are all rules that I have to help me, to instruct me to take action if the market moves against me, right? If it goes to my emergency stop, that's an action that's moving against me. If it closes below my end of bar stop, that's an action that moves against me. If I have a close below a previous bar's low after reaching trailing stop, that is a movement against me. So this is all defensive, but I also like to play offense in my trading as well. And the way that I do this is I take partial profits when the market gives me a certain amount each day. So every day, if it moves a certain amount, I'm going to take partial profits. Not all, but I'm going to take a portion of the position off. So this is a real trade. Let me show you how I'm going to do this for Monday. Again, I change this every day. All I do is I take the closing price. Right now, the closing price is 552.66. 552.66. And now I look for the value of the 0.45 ATR. The 0.45 ATR is now 445. This changes every day. So I take the closing price plus 4.45. My first profit target for Monday is 557.11. And if it gets there, I'm just going to take off 10% of however many shares I have going into the day. If I have 50 shares going into the day, I'm going to take off 5 shares at that point, right? But I always place 3 profit targets per day. So the closing price plus the value of the 0.45 ATR, which is 445. Add those two together, my first profit target's 557.11. But now I'm going to place another one. I take the first profit target, 557.11, and then again, the value of the 0.45 ATR. Add those together. My second profit target for Monday is 561.56. And so if I hit my first profit target, I take 10% off of what I have going into the day. If I hit the second profit target, again, 10% off of how much I had, and then I place the third profit target. I take the second profit target plus the value of the 0.45. My third profit target is 566.01. So I always place 3 profit targets as a limit order in my system. And again, if I went into the day with 50 shares, I would take 5 off at the first profit target, 5 off at the second, and 5 off at the third. And you don't. If it's down on the day, you don't hit any. Or, well, that's not true. You can open up and hit one, and then it can go down. But sometimes you hit 1, sometimes you hit 2. If you have a really good day, you hit 3. If you have a great day, you hit 5 or 6. And I'll show you one of those today. So that's the offensive part of the trading, taking the partial profits. All right, so we're playing offense and we are playing defense. Okay, so with that all said, let's kind of run through the trade. And again, here I entered on June 20th at 532.95. Intraday rejection of the 200-day moving average, intraday rejection of the 30 RSI, I position size, I placed my emergency stop 2 ATRs below, my end of bar stops closed below the 200-day moving average, I placed my trailing stop level 1.5 ATRs above. Next day, right off the bat, goes up, I hit a profit target. Great. Next day, really goes up strong. I hit multiple profit targets, which is great because now I'm reducing my position size as it's moving up. And I also got to trailing stop level. Doesn't mean I do anything. It just means that now in the future, if I have a close below previous bar's low, I get out of half. That happened here on the 25th. You can see we had a close below the previous bar's low after reaching trailing stop level. I took off half of the remaining shares that I had for a gain of 3.07%. After that, we went up, hit a profit target, hit a profit target here, hit a profit target here. And then we moved sideways, didn't do much, no profit targets. Then we had to move down. And from here, we have just moved sideways. So the remaining shares that I have on this particular stock, MasterCard, up 3.58%. So going forward now, if it continues to move up, I'm going to continue to take partial profits. If it gets to a 65 RSI level, now the 5 EMA is going to come in for a trailing stop. If we actually get up to the 70 RSI and reject it, I'm going to take off half the remaining shares. After that, if I have a close below previous bar's low, after rejecting the 70 RSI, I'm completely out of the trade. If we come down and close under the 200-day moving average, what do? I'm simply going to get out of the trade. So, I have a lot of rules in place. I've been trading for over 30 years. The reason I use these rules, every rule really has a specific reason for being in my strategy, and it's all there to help you lose less money and make more money. But again, this is a good example of a deep dip buy combination of a rejection of the 200-day moving average and a rejection of the 30 RSI. And I've been using this for years. I've been teaching this deep dip buy for years, and you should learn it. It really is good, and it doesn't work all the time, but sometimes you can have really big wins, and most of the time you're going to have really small losses. So nice example of a deep dip buy, and the remaining shares up 3.58%. Okay, next trade is McDonald's. All right, so McDonald's is also a deep dip buy. This time, not off of the 200-day moving average, but the 300-day moving average. So deep dip buys use either the 250, the black line, which is the 200, the purple line, which is the 250, or the 300, which is the orange line. So I bought McDonald's here on the 26th of June with an intraday rejection of the 300-day moving average. Another deep dip buy. I bought this at 285.61. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 300-day moving average. You see how close I am, giving me a good risk to reward ratio. I placed my trailing stop level 1.5 ATRs above. The next day just takes off like a rocket ship. I hit multiple profit targets. The next day up a little, not enough for a profit target, but I do get to trailing stop level. Again, which means if I have a close below previous bar's low, I get out of half the remaining shares. The next day, up big. Again, multiple profit targets on this day. And then we move sideways for a few days. We do not have any partial intraday profits. And then here on the 8th was our first close below a previous bar's low. After reaching trailing stop level, I took off half of the remaining shares that I had for a profit of 2.12%. And then we continued up. Next day up a little, not enough for a profit target. Next day up big, multiple profit targets. Next day up, one profit target. And then since then, we've just kind of moved sideways for the last week. Did hit a profit target here on Thursday. So the remaining shares that I have here at the moment on McDonald's up 3.80%. But really good trade. And I guess the thing that I really want to kind of point out to you here was this rejection of the 300-day moving average was such a good risk to reward ratio. If the next day it had just closed literally 1 penny below, I would have just gotten out for a very small loss. But that's how you have to structure your trades. You need, in my opinion, you need to wait for good support levels, RSI levels, moving average levels, order block levels. Wait for those levels to be rejected. Wait for the market to show you that it's rejecting a level. Position size correctly. Enter. And then if you're wrong, having your price very close to the level that you're going to be wrong. So if you're wrong, it's a smaller loss, but with large upside potential like on this trade. I didn't know this trade was going to be this good. All I knew was it rejected this level. It's a good risk to reward ratio. We'll see what happens. Worked out great. So the remaining shares on this up 3.8%. And again, if it keeps going up, I'll continue to take partial profits. If it gets to 65 RSI level, then other rules kick in because it starts getting extended. If it just heads straight down and closes under this 300, what am I going to do? Just get out, right? Etsy. It's really glad I had this trade. I mentioned to you last week that, I've had some of my students and people comment, Greg, I never see you take a higher low V1 or V2 anymore. Do you not use them? I'm like, yeah, I absolutely use them. It's just that the market has not had a lot of these patterns. But here, this is the pattern that I'm going to show you, and it's worked out really well. So a higher low V2, the first thing you have to identify is where is the value zone. The value zone, the top of the value zone is this green line. The bottom of this value zone is this bottom green line. So anywhere in here is your value zone. So the first requirement for a higher low V1, V2 is that you have to close below the low of the value zone. Well, that happened here. All through this time, we were below the value zone. Second, you have to come into the value zone. You have to eventually close back in, which we did here. Third, you have to have a pullback and then a V1 or a V2 that closes into the value zone. Well, I took here on the 9th of July because we had a V2, bar 1, bar 2, bar 3. A V2 consists of 3 bars, bar 1, 2, and 3. 2 has to go below bar 1's low. Bar 3 has to close above bar 1's close, forming this V2. So this is called a higher low V2, higher low V1 or V2 in the value zone. Well, here you go. We close below the value zone. We close in the value zone. We have a pullback. We form a V1 or a V2. And the reason it's called a higher low V1, V2 is you see how this low here is higher than these lows here? That is your higher low. So again, close below the value zone, goes into the value zone, pulls back, forms a V1 or a V2 that's higher than the previous low. There you go. That's my entry, 54.06. I position size as I should. I place my emergency stop 2 ATRs below. And then on a higher low V1 or V2, your end of bar stop is simply a close below the washout bar, the V2. The washout bar on a V2 is always the middle bar. If it's a V1, it's the second bar. And this may sound complicated, but it's really not. If you go to my YouTube channel, I have a video there on V1s and V2s that goes into more detail. But in any case, the second bar is called the washout bar, and the end of bar stop is simply a close below halfway of the washout bar. Here's the washout bar, here's the bottom, here's the top. I place a line in the middle. If after I take the trade, it closes even 1 penny below halfway of the washout bar, I'm out of the trade. Okay, so I have a higher low V1, V2. I have my emergency stop 2 ATRs below. My end of bar stop is closer, right? Much closer, halfway of the washout bar. I place my trailing stop level 1.5 ATRs above, and the next day just takes off like a rocket ship, which doesn't surprise me. These higher low V1s, V2s, this happens all the time. And I hit multiple profit targets here, which was great. I also got to trailing stop level, had a couple days sideways. And then here on the 15th was our first close below a previous bar's low after reaching trailing stop level. I took off half here for a gain of about 3.26%. Next day we go sideways, nothing burger. Next day we're up big. I hit multiple profit targets, and then I hit another profit target on Friday. So the remaining shares on this higher low V1, V2 currently up 9.36%. Now, we're starting to get a little bit extended. We are at a 63.82 RSI. So that means if we go even a little higher, then we're going to get to a 65 RSI. If that happens, then this 5 EMA comes into play. In other words, if it gets to 65 RSI, then in the future, if it closes below this 5 EMA, that's my complete signal to get out of the trade, right? Because this 5 EMA is going to follow the price very closely because it's shorter moving average. And so this essentially, if we get to 65, now this becomes my trailing stop level. Again, if we go higher and we reject the 70 RSI, then I'm going to take off half. After that, if I have a close below a previous bar's low, that is my exit, fully exit. So it's important in trading that you have rules to know, to tell you to do exactly what you need to do regardless of what the market does. Or in other words, whatever the market does, you need to know what you're going to do, right? Because you can't control it. So here I know if it goes up to 65, 5 EMA comes into play. If it goes up and rejects the 70, I'm going to get out of half. If for here it just continues down, 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 well, I'll stay in the trade as long as it closes above halfway of the washout bar, my initial end of day stop. So great trade, great example, higher low V1s, V2s. Look into these. These are really great signals, really good risk reward signals. So, okay, let's go to the next one. Alibaba. A couple of my students took this trade. I was very happy to see that as well. So let's see here. So entered Alibaba on the 14th of July. Why? Again, this is a confluence. This is a confluence of two things. This is a confluence of a deep dip buy. This is a simple close under, close over the 200-day moving average, which is a legitimate signal. But it's also in combination with what is an order block. An order block is this green box here. And let me take you all the way back. So from the high of the box to the low of the box is the order block. So this particular order block, anywhere in a rejection of the high of this order block would be a legitimate signal, but your end of bar stop on an order block is the low. So this was too much range. So the reason that my students and I took this trade here was because the 200-day moving average was right here. My favorite trade is when you have a deep dip buy signal, like an under 30, over 30, or a rejection of the 200, 250, 300, that's inside of a bullish order block. So on the day that I took it, not only did we have a close under the 200, over 200, but we also rejected the order block. We closed in it, then we closed above it. That is a rejection. So got long here, 108.07. Position size correctly, placed emergency stop 2 ATRs below. My end of bar stop's very close. It's just simply a close back below the 200. Place my trailing stop level 1.5 ATRs above, and then blast off. Just literal blast off the next day. I personally hit six profit targets. One of my students told me he hit 7. I'm not sure why we were off on the math, but it doesn't really matter. It was great. So now I'm in trailing stop mode. Clearly, took off all these profit targets. Next day didn't do much. Next day up again, hit another profit target. Friday up again, more profit targets. So I'm in trailing stop mode. Not quite to 65 RSI, so the 5 EMA is not coming into play. But really, for this particular trade, because I took so much off, I'm following the rules, but I'm not sweating this trade because it's up so high. So this particular trade, this again, combination of a deep dip buy along with the rejection of a bullish order block, remaining shares on this trade up 10.07%. All right, and then the last of the open trades, BITO, which is Bitcoin. Let's see, ETF for Bitcoin. So I got short Bitcoin on Thursday, the 17th of July at 22.87. So why do I get short here? Well, it has to do with this red block over here. This is called a bearish abandoned baby. And so an abandoned baby happens when you have a gap up. You see from this close to this open, we gapped up. So for whatever reason, everybody was really super excited about Bitcoin on this particular day. However, the very next day, we gap down. So if you have a gap up, and then the very next day, you have a gap down, that is called a bearish abandoned baby. And I believe the reason why this indicator works is because it's a very quick shift in sentiment from extremely bullish quickly to bearish, right? Gap up to gap down. So you can see the reason they call it an abandoned baby is because it's kind of abandoned up here. It was up and then it was down. So when this happens, you could take the trade as soon as at the opens, because as soon as you have if you have a gap up and then you see it has a gap down, okay, there's a abandoned baby. That's shortable, but I like to wait for a check back. I like to wait for after it's gapped down. Very often it will have this knee-jerk reaction where it goes back up, and if it goes back up, I want to see it reject the bottom of that abandoned baby. That's the key level now. And you can see on the day that I took the trade, it did get above the low, but then close back below. So I got short here, 22.87. Now on abandoned babies, also island reversals is very similar to abandoned baby, but it uses more than one bar. With this, I don't take partial profits. I don't go into trailing stop mode. I do this particular strategy, very simple approach. I place my 2 ATR stop above like I do on any trade. And then I place a 4 ATR profit target below. So I'm risking 2 ATRs to make 4 ATRs. I put my stop in the system up here. I put my profit target in the system down here. 2 ATR stop, 4 ATR profit target. This is correct trading. Wait for a signal. 2 ATR profit target, 2 ATR stop loss, 4 ATR profit target. So I have a 2-to-1 ratio there. If I'm right, I'm going to make twice as much as if I'm wrong. And so this is what I'm doing. I'm just going to let this go eventually, right? I think you'd have to agree. Eventually, we're either going to go up here in which case I know exactly how much I'm going to lose. Eventually, if it goes down, we're going to get to here. And so that's it. It's just kind of a set it and forget it trade. And so far, it's doing pretty good. It's got a long ways to get to the profit target, but currently this short on BITO is up 1.4%. So those are the current, again, open daily positions. MasterCard remaining shares up 3.58%. McDonald's remaining shares up 3.8%. Etsy remaining shares up 9.36%. BABA remaining shares up 10.07%. And Bitcoin, the short, up 1.42%. So pretty good positions there, I would say. Pretty good week. Okay, so in addition to trading the daily charts, I also like to trade the weekly charts as well. And I've got 3 positions here, and I'll show you these now. So starting off, by the way, weekly bars close on Friday. So I make my buying and selling decisions on a Friday. So back here on the 11th of July, last Friday, we had the bar close, and very similar to Alibaba, we had a confluence of signals of a close under the 200 week moving average, close over the 200 week moving average, deep dip buy, but we also have a rejection of this very thin bullish order block. This is a rejection because it came into the order block and then closed above, rejected the order block. So that is the confluence of signals. I entered UUP, which is the US dollar, at 27.21 because of that confluence. I position size as I'm supposed to. I place my emergency stop 2 ATRs below. My end of bar stop on this is just a close below the 200 week moving average. If this week had closed below that 200, it would have invalidated the trade and I would have been out. Again, placed my 1.5 trailing stop level above. Was up this week. We have not got to trailing stop level, but so far so good. I mean, right out of the bat, it is positive. Not a ton, but up 0.8%, which is actually for the dollar, that's pretty big move. But again, you see the confluence, the close under the 200, the close over the 200 week moving average, deep dip buy. And we dovetail that with the rejection of the order block, which is the green level here. We closed in it, then we closed above. So nice confluence of signals. This particular trade up 0.8% in the first week. TLT, oh man, I feel like I've been talking about this trade for years, but it has not yet hit my stop. It has not hit my profits. So I am still in the trade. Seems like for 20 years, but actually I got into this trade here on the 17th of January. So at the beginning of the year. Why? Simply a rejection of this bullish order block on the weekly. The week before we closed below it, and then we closed back above it. So I got long here at 87.20. I position size, my end of bar stop, or excuse me, my emergency stop is 2 ATRs below. My end of bar stop is simply a close below the low of the order block. Place my 1.5 ATR trailing stop level here, and away we go. Next week, basically break even. Next week, up a little, I hit one profit target. Next week, up again, I hit another profit. Couple weeks of nothing. On this week here, on the 28th, we had a big move up where I hit multiple profit targets and also got to trailing stop level. Then we didn't do anything for a month. And then here we had a nice big up bar again, where again, I took off partial profits because the market gave me something. I'm going to take a little. And then kaboom. Yields just went through the roof. TLT went down. We had our first close below a previous bar's low. After reaching trailing stop level, I had to get out of half of the shares for a loss of 0.59%. But keep it in perspective, everybody. Do you see the importance of taking the profits while I had them before the boom happened? Okay, right? So when you're taking partial profits and it moves down, you're glad that you took them. So the next week up a little, next week up again, little, took a little more, hit one more profit target, and then we just went straight down for a whole month, but did not close below the low of the order block. And then we've kind of been trying to move our way back up slowly here. Not really even enough for profit targets. And then the last few weeks we have been down. So the remaining shares on this particular trade are currently down, not a lot, but down 2.25%. But it's a good example of showing why it's important to take partial profits when the market gives them to you, right? Here we are now. Am I glad I took partial profits up here? 100%. Am I glad that my trailing stop level signal that I got out of half here? Right now, yes, for sure. But, TLT pays the dividend of about 4% a year. So I have been receiving dividends on this as well. But the remaining shares down 2.25%. And then last but not least, Shopify on the weekly. I did enter a trade on Shopify to the short side on Friday, yesterday at 127.03. So why would I get short here? Well, I talk about order blocks. Usually they're green for bullish order blocks. This is a bearish order block. That's why it's red. And so what makes this an order block? Well, look, we have a swing high here. We have a swing low here. We have a higher swing high here. And then we have a big move down, which breaks structure, which technically turns us into a bearish market structure. So if I have a bearish market structure and then I rally back to the bearish order block, that is why I am shorting. And the reason that I shorted on Friday is because we rejected the high of this order block. Again, the order block's the high and the low here. This is the highest up bar close before market structure change. During this week, we popped our head out of the top of that order block, rejected and closed back in. That's a rejection. So I got short here, 127.03. I placed my emergency stop 2 ATRs above. As always. Now, because I'm short now, my end of bar stop is simply a close above the high of this order block. The high of this order block here is 128.57. So next week, if it closes even 1 penny above 150, what did I say? 128.57, I'm simply out of the trade. That's it, right? I have my worst case scenario up here where I lose 1%. So I've been watching a lot of these stocks and these high moves up for rejection of order blocks. So that's why I finally did short Shopify here at 127.03. I placed my 1.5 ATR trailing stop level below. If it moves down the value of 0.45, I will take partial profits, just like I do on the long side. So this trade basically exactly break even. But there you go. So those are the current weekly trades, the current daily trades, and was a really good week. And I'm glad here for the podcast today that shows you deep dip buys, higher low V1s, V2s, bearish babies, order blocks, right? So it was a good week to show you examples of all the different strategies that I use and teach. And by the way, if you would like to learn from me, I do teach private one-on-one lessons in the evening time. I teach a 20-hour one-on-one course, so we spend a lot of time together. But I teach you all the different trading strategies that I use. I teach you all the rules step by step. We do lots of simulation trades where you basically have to prove to me that you know what to do in any situation. I have taught students from all over the world, from absolute beginners all the way up to the hedge fund level. And I've really watched a lot of them grow and bloom into great traders. I've been doing it for years, And I would love to have you as a student. And I really do believe that the best way to learn anything is one-on-one. And so, yeah, lessons once a week for 10 weeks. So we'll get to know each other a lot, and it's kind of nice too because we can watch how the market unfolds. We can watch how things change, and so it's just a good example. So if you would like to become my student, if you'd like to do this one-on-one 20-hour one-on-one course with me, just send me an email. The email is in the link of the description. And usually I kind of like to have just an initial call to kind of see if we're a good fit for each other. But yeah, if you really like to learn to trade and do it with somebody that has been doing it a long time, send me the email. And by the way, I was talking about deep dip buys there a lot too. In addition to the one-on-one course that I do have specifically for deep dip buy. I have a great deep dip buy course. It's 9.5 hours. It's at udemy.com. It's very affordable. 9.5 hours of content, and if you're interested in that, the link is in the description of this YouTube video, and I'll talk a little bit more about it when we get to the end of the podcast. So anyway, there you go, everybody. Those are the positions, great examples of lots of different strategies, but what do they all have in common? Everything, what they have in common is they're different strategies, but they have good risk to reward ratios, where the chance, if you're wrong, you can be wrong quite small, and if you're right, you can be right quite big, like in this example. So before we head over and start taking a look at the potential trades for next week, let's do a little bit about trader psychology. Here we go. This is from Marty Schwartz from Pitbull Trader and Market Wizard, and Tony Stark always provided this. Tony always provides really great posts. But I read this and I was like, oh yeah, I'm going to talk about that on this week's podcast because it really is true. You will never be more objective than before you execute a trade. Once you are in a trade, emotions take over, so your plan must be in place beforehand. Everybody, this is so true. As soon as you're in the trade, everything changes. Now you have a bias. Well, I think it's going to, yeah. Before you're in a trade, you can look at it very objectively and go, has that changed market structure? Yeah, I don't think so. But if you get into the trade and market structure changes against you, you're like, yeah, but maybe it will go back up, so forth and so on. Do yourself a favor. Make sure that you really want to be in a trade. Make sure that you can defend your trade in a court of law to somebody if you have to, right? I mean, when I'm in a trade and everything's perfect and the structure's there, I'm like, hey, it's fine. I am supposed to be in this trade. But if I ever, take a trade that's maybe not perfect, as soon as I take that trade, I start to question and go, I don't know, that wasn't really perfect. Maybe I shouldn't be in this trade. It's just a much better feeling, everybody, to be able to defend your trade in court. So you will never be more objective before you execute a trade. Be objective, be selective. Don't take the trade unless it's really perfect, right? Because once you're in the trade, emotions take over and you look at it completely different. So you look at a trade differently before you're in than after you're in. So make sure it's perfect before you get in, and it will feel a lot better, right? It'll feel a lot better when you're in that trade if you knew going into the trade that it's perfect. So you will never be more objective than before you execute a trade. Once you're in a trade, emotions take over, so your plan must be in place beforehand. Again, coming down to having a plan, knowing exactly what you're going to do regardless of what the market does. And if you need help with that, I will promise you, I will teach you an exact plan. I've had many students come to me, even hedge fund level, and they're looking for a precise plan. And you need it. You need it. And that's what I will teach you. Okay, so let us talk about potential trades for next week. Now, again, these are not where they need to be yet. If they were, I probably would have already taken the trade. They're not there yet, but they're close. So this is Berkshire Hathaway. Oh, and I should say, by the way, that look, I have 5 symbols here, 5 potentials for next week. Theoretically, they could all trigger on the same day. Does that mean I would take all 5 of them? No. I only take one trade per day or per time frame, even if I have multiple candidates. I have to narrow it down to the best candidate. How do I do that? Well, I give it a quality score. If it has 1 entry signal, I give it a score of 1. If it has 2, I give it a score of 2. If it has other things like double bottoms, bullish divergences, ATR divergences, any other signals or conditions that are bullish, I give it a higher quality score, and then I just simply take the trade that has the highest quality score. I also look at higher time frames, what they're doing, relative strength, so forth and so on. But just like a report card, I'm going to take the best student. I'm going to take the student with the best score. And so here's 5. I'm going to, if they all trigger on the same day, I have a way to determine what is the best one all in all. You also have to figure in risk to reward ratio. And again, this is what I teach my students in my one-on-one course. So here is Berkshire. So there's a couple things, Berkshire really is surprising. I mean, the quality of this company to have this, look at this go down and down and down and down and down while the markets are making new highs. It's crazy, right? Well, we have a order block, a bullish order block within a bullish order block. The first order block is this big, tall green one. Well, this is a very wide order block, so I was waiting for it to get to the 200, which I did here on the 18th, but then it closed underneath. I had to get out, so it was a losing trade. But I've been continuing to watch Berkshire because there's a lot of things bullish, double bottom, bullish MACD divergence inside an order block. But now we've also created, again, from the high of this green box to the lowest of this green box is an order block. But we have just created a new order block. So we have an order block within an order block. Why? Well, an order block happens when you have a swing low followed by a swing high followed by a lower swing low and then market structure change. So we did actually on Friday change market structure to the upside because we took out the swing low here on the 14th. So now we look at the lowest bar close before market structure changed. This blue box within the green box is the newest order block, which is interesting. So what am I looking for here? Well, we are back in the order block. Just by itself is okay. But you see the bar here on the 17th, the big up bar here? If you have a big up bar and go down halfway of that big up bar, that is a support level, Fibonacci support level. So what I am going to be waiting for is if we move down and reject halfway of this big up bar here, 470.90. That's what I'm looking for. It's already an order block. If it closed above the order block, the blue order block on Monday, I would consider it. I would consider that also. But ideally, what I'm really looking for, what my experience tells me, is if we reject this 470.90 area, and by rejection, I mean we go down, we bounce off it, close above it, or we go below it and then close back above it. That's what I'm looking for. So essentially, I am keying off of this 470.9 level. Now, another way to look at this is, look, from a deep dip buy perspective, we have the 250-day moving average here. We have the 300-day moving average here. So if we went lower and rejected the 300, that's still a 300 rejection inside the big green order block. That would be legitimate. If we come down, reject the halfway of this bar on the 17th, the 470.90, I think that's the most likely. But if we also close back above the 250-day, that would also be a potential for me to get in. So a lot of different options with Berkshire here. I think the most likely is we reject the 470.90 location. But I am going to be watching it for a close above the 250, potentially. Close a rejection of the 470.90 potentially, or a rejection of the 300-day moving average, which puts us all the way down at 466.29. So there's a lot of things going on big picture with Berkshire here from a MACD momentum perspective, and we are quite oversold. So I'm going to be watching Berkshire carefully. FXY is the Japanese yen, and we have here, you can see Japanese yen had a pretty big rally and has come all the way back down. But what I'm looking for on FXY is this order block down substantially down here. The high of the order block is 61.24. The low of the order block is 60.87. And it's a pretty narrow order block, so the risk reward's not so bad. So really what I'm looking for, we have the 200 here, yes, we have the 300 moving average here. I could look for a rejection of the 200. That's one potential. I could look for rejection of the 300-day moving average. That's another rejection. But if we come down to the top and reject the top of this order block, we very likely will have also rejected the 30 RSI level as well. So my experience is just kind of telling me that really this, either the 300s is a spot or a rejection of the high of the order block, because you'll have a rejection of the high of the order block along with probably a 30 RSI reading. I have to leave myself open to the fact of maybe getting in with rejection of the bottom of the order block as well. So I know this is all pretty subjective here, but I guess what I'm saying is somewhere in this area is kind of the viable area. But just to kind of sum it up, look, a rejection of the 300-day moving average, that would be a potential. A rejection of the high, the order block there at 61.25 would also be a level that I would be interested in, and a rejection of the low of the order block at 60.87. So that's what I'm going to be watching on FXY. Coca-Cola, KO. All right, so Coca-Cola, this one's fairly simple. Don't know if it will get there, but we have earnings coming up, so it might. The green box here is the bullish order block. Remember, my favorite trade setup is when you have major moving averages inside the bullish order block. Well, we have them. They're all here. Here's the 250, the purple. Here's the 200, which is the black line, and the 300, which is the orange line. They're all living inside this bullish order block at the moment. So that's what I'm going to look for. I'm not looking for rejection of the high of the order block. The range is too long. Rejection of the lower of the order block, sure, but to be realistic, the rejection of the 250, the 200, or the 300 in this bullish order block, that's what I would be looking for to get long. Pfizer. Okay, so, Pfizer's not there yet. It may get there, but we have a nice thin order block here. And again, why the order block? We have a swing low, followed by a swing high, followed by a lower swing low, followed by a market structure change. So the high and the low of the high and the low of the lowest closed bar before market structure change becomes your order block. You run that out into time here. Here it is. We are not there yet, but I would be interested in potentially getting long Pfizer if we reject the high of the order block at 23.44 or reject the low of the order block at 23.05. And if it gets down there and does that, I'll consider taking the trade. If it doesn't, I just won't take the trade. But that's what I'm looking for. Simple rejection of the high of the order block or the low of the order block. And the high of the order block is 23.44. The low is 23.08. Last but not least on the daily is Verizon. I really like this setup. Again, we have the bullish order block in green. We have the 200-day moving average that lives inside the order block. Technically, on Friday, this was a legitimate buy. It did reject the bottom of the order block and close back in it, but I did not take the trade because the earnings are on Monday. I do not like to take trades and hold them through earnings. So if earnings are good and it closes back above the 200, I could potentially take it there. If they're bad and it goes down, look, There's the 250-day moving average here. The 300 looks really interesting because not only is it the 300, which is pretty strong by itself, we're also at the negative third ATR channel here, and we would be closer to a 30 RSI as well. So, all of this could go out the window depending on what happens with earnings, and that's why I did not take the trade here. But after earnings coming out on Monday, and get that behind us, then I'll just have to look and see. If it comes out and has a nice gentle close above the 200, sure. That's a deep dip buy within a bullish order block. If it goes lower, rejects the 250, I consider it there. And again, if it goes to the 300-day moving average, and that's kind of dovetailing with the negative third ATR channel and the 30 RSI, could potentially take it there. So those are the daily trades, and then the weeklies. Let's see what we have going on the weeklies, and then we'll wrap this all up. So here's Adobe. Adobe has not participated whatsoever in this big market rally, but it's an interesting level here. Right now, we are in a bullish order block. We had a swing low, followed by a swing high, followed by a lower swing low. We changed market structure to the upside. This is the lowest bar close before market structure changed to the upside. So the high of this order block here is 362.05. The low is 341.31. This right here, right now, what it did on Friday is a legitimate entry because it went into the order block and closed back above it. That's legit. I didn't take the trade because it's a kind of a wide order block. What I am keying off of is this 353 level, this green line within the bullish order block. Why? Well, if you take it back to the left, you see the big up bar we have. Big up bars, if you go back to halfway of the big up bar, that is the inherent support. And there we go. So if Adobe rejects this 353 next Friday on the weekly, I would consider taking it. Of course, if it rejected the low of the order block at 341.31, I would also consider that as well. So either one's potential, but Friday was a legitimate entry. It rejected the higher of the order block. But again, I'm looking for a rejection of 353 or the low of the order block at 341.31. Amazon. This is completely opposite. I am looking for a short on Amazon in this bearish order block. Why? Well, here's the big down bar. If you have a big down bar and you rally to halfway of that big down bar, that's inherent resistance. So I am looking, just to make it simple, I am looking for rejection of 233.70 to potentially get short. If I got short and then it closed back above that level, I would get out. So rejection of 233.70 or a rejection of the high of the order block at 241.77. I drew that a little. Oh, shoot. Now I really messed it up. Oh, there we go. Now it looks better. So rejection of 233.70 would be my first entry spot, or ultimately a rejection of 241.77, just like I had on Shop. Same thing, rejection of the high. FedEx, FDX. Okay, we are in a bullish order block at the moment, and this either just needs to go higher or lower for me to get interested. If we close back above the 200 next Friday, that's a potential entry. Deep dip buy within a bullish order block, close under, close over the 200, that's potential there. If we go lower and reject the 300-week moving average, where's that at? That's at 219.19. That would potentially also be another entry. Or, of course, if we go much lower and reject the bottom of the order block at 202.59. So a lot of different potentials here on FedEx. One, if we go higher and close above the 200, now I can use that 200 as my line in the sand. If we go lower, reject the 300-week moving average, that would also be another level. Or the low of the order block, rejection of 202.59. Tesla, TSLA. Okay, we have a bullish order block below us. We have major moving averages inside the bullish order block. We have the black line, which is the 200 week. We have the purple line, which is the 250. We have the 300 poking its head. now living inside the bullish order block. So I've been talking about this for weeks. We just have not got down to it. We changed structure here. We came back, bounced right at the top of the order block, but I didn't take the trade. Would have been a good one. But that's what I'm looking for. I'm looking for rejection of the 200-week moving average, the 250-week moving average, or the bottom of the order block, or the 300-week moving average. So we'll see what happens there. VIX. You know, VIX is a wild animal and a wild beast. VIX is volatility. And, you know, everybody hates VIX, and then it explodes up. I mean, look here. In January, we were at 41. We went to 91. We more than doubled. And now we've given it all back. But we are coming into quite a level of support on VIX. Whenever we get down to kind of this level, that seems to be about the bottom. And that bottom is coinciding with this bullish order block here. The high of the order block is 41.46. The low of the order, or I'm sorry, 43.40, and the low is 41.46. So this level right in here is about, normally, not all the time, this is about where VIX stops going down and goes back up, which tells you a little bit about the market too. If VIX comes down into these levels, that could very likely mark a top for the market. And you know, the markets in general, it's extremely overbought here. And the VIX, it's not surprising that we're down at these levels, but again, when we get down to these levels, VIX tends to bounce, and what does that do to the market? It makes it go down. Look here, we were at the highs, and then we got down here. What happened to the market? Went down, so VIX went up. Now VIX is going down, market goes up. Now we're getting back to these levels. So this could kind of give you an idea to help mark the top of the market. But as far as the actual VIX trades go, if we reject the high of the order block, I would consider taking it there. The high is 43.40, or if we reject the low of the order block, 41.46, I would also consider getting along there. And then last but not least, everybody, is XLV. I have been talking about XLV for weeks and weeks and weeks, but just have not got to the spot that I wanted to get to. And where is that spot? Well, you see the bullish order block here. It's a pretty wide one, 128.53 down to 122.68. I am simply keying off the 300-week moving average. That's the orange line within the order block. If we go down and reject that, that's my favorite trade. Long-term moving average that was rejected inside a bullish order block. So that is what I'm looking for, and the 300 there is at 127.50. So I hope you found some value in this today. If you have any questions about anything I discussed, just put them in the comment section. I'll do my very best to get back with you. If you like the content and was helpful, I'd appreciate it if you could hit the thumbs up button or subscribe. That would be even better. If you would like to become my student and do the 20-hour one-on-one course with me, please send me an email. I promise you I will teach you everything I know. I promise you I'm going to teach you a skill that you can use the rest of your life, and I know you're going to be happy that you did it, so just send me an email. But I really appreciate you being here. I always like to leave off with, please try to go out and do something nice for somebody today. If we all did one nice thing for another human being, it really would make the world a better place. If you could try to go out and do one nice thing for an animal each day, or whenever you have the opportunity, that's a good feeling. They appreciate acts of kindness just like we would, right? So that's how I like to leave off. I really hope you have a good rest of your weekend. Please be careful next week. Follow your rules, and if I can help you with anything, please let me know. And on the way out here, I have to run the U.S. legal disclaimer. So thanks so much, everyone. We'll talk to you soon. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.